Hi everyone, thanks for tuning in. Previously I shared that I'd hit my third consecutive year of more than 15% returns. Well, thanks to Santa, my XIRR actually edged up to 18% now. Today, I'm lifting the hood to show you my 5 best and worst stocks for 2025. I'll talk briefly why I bought them, why they performed the way they did, and what I'm doing with them next. Let's go. At a glance, it's a pretty nice picture. My top 5 gainers made at least 40% return, and with the exception of the trade desk, the other 4 laggards only made at most a single-digit loss this year. Do note that these figures include dividends. Also, for my US holdings, these numbers account for a 5 to 6% forex headwind due to the strengthening Singapore dollar this year. Now let's look at the ones that hurt first. Let me begin with my worst performer, the trade desk. I first bought Trade Desk last March as I was impressed with its explosive sales growth and immense potential in programmatic advertisement. It went well for a while, until boom. Growth dipped below 20%, investors got spooked, and the price plummeted. The market punished it because it was priced for perfection, but I still believe in CEO Jeff Green's vision. I averaged down 3 times this year from $83 in February to the recent $39. This is likely my maximum exposure. It's time to just sit tight and wait for its recovery. Next is Tractor Supply, a staple in my portfolio since 2020. I love their rural life niche, but like most retailers, they've felt the sting of high interest rates. Growth was muted this year, but with comparable store sales up 3.9% in the latest quarter, I think a turnaround is close. I added to my position in February and I'm holding firm. Micromechanics is a long-term dividend play for me. Even though it's a small-cap semiconductor-related stock, they are incredibly transparent and shareholder-friendly. Despite a business recovery, the share price stayed flat this year. This is likely due to low liquidity and a lower dividend payout this past year. I'm staying patient and I'm expecting a brighter 2026. Veeva is an interesting one. Their transition away from Salesforce to their own platform created a cloud of uncertainty regarding client attrition. The share price has been ding-donging to the rhythm of every rumor of successful client migration and client leaving. Technically, the stock is still up for the year, but it shows as a loss for me once converted back to Singapore dollar. As for the client attrition, I'm not worried. Their independent platform will eventually allow them to scale faster. I'm considering increasing my stake as I believe they can hit their target of doubling their sales by 2030. Finally, Food Empire. It actually made a massive gain of 141% this year. It is only in my bottom 5 because of my late reinvestment, and if not from my recent addition at $2.60, it won't appear in this list. As long as they can execute their growth plan, I'm not too late to the party. And now for the winners. But before that, I would appreciate it if you would hit that like button and subscribe. It really helps the channel grow. First on the list is UMS, reinvested last year as I was excited about its new key customer. The numbers are not showing in the P&L statement yet, but the increase in inventories means the ramping up is happening soon. Besides this growth potential, its secondary listing on Bursa Malaysia and upcoming 1-for-4 bonus issue probably drove up its price. I'm holding on for the ride. I honestly didn't expect the Hourglass to perform this well after they cut their final dividend. While the artisan watch craze has cooled since COVID, their customer base has grown larger. Their expansion into Australia and consistent share buybacks probably pushed up its share price. I'm holding my shares and hoping for a dividend rebound next year. If you follow my blog, you know I love Shopify. They win when their merchants win. The market loved their momentum this year. Their revenue growth accelerated from 27% in the first quarter to 32% by the third, sending the stock up 60%. I took some profit in November, but I'm keeping the rest of my core position running. In February, I wanted to diversify away from tech and caught Ulta at a major discount. I resonated with new CEO Kecia Steelman's focus on customers. Her Ulta Beauty Unleashed strategy had an immediate impact, leading to a series of beat and raise earnings. This resulted in its stock surging much faster than I expected. I'm not complaining. After adding more in March and October, I'm happy to just hold here. Finally, Alphabet, which is up more than 60% for me this year. Last year, everyone thought ChatGPT would kill Google, but I didn't buy it. Hence, I initiated a position last March. I doubled my position early this year when Alphabet continued to do well, but traded at a discount due to uncertainties from the antitrust cases. My conviction was rewarded when there's clarity of the outcome from the antitrust case and the cloud business kept growing. I trimmed a bit in October to rebalance, but I'm holding the rest for the long runway ahead. Those are my top and bottom 5, but remember, weighting matters. If you want to see which of these stocks or other stocks actually moved the needle of my portfolio, check out my full blog post. You can find the link in the description. I've also included the links to the detailed write-ups for the stocks mentioned today in the post. Thanks for watching. Don't forget to like and subscribe for more stock insights. Happy holidays!